pick. So yeah, we are doing a little practice what we preach here. And this first stock I'm going to talk about is Kinsdale Capital Group. This was on several of the lists that I was looking at as I was going through and preparing. And Ken pointed it out on some of the predefined lists. It's all over these lists. So when I find a company, especially a small company that is on multiple lists, and I don't know a lot about it, and it's got lines that look like that, I'm intrigued. And before I get going too far, I also want to disclose that our organization, Better Investing, owns this in an investment portfolio, which I didn't know when I picked it, but I know it now. I just do want to disclose that. So let's look at this a little bit. I didn't know anything about this. This is in the financial services sector. You can see that the industry is insurance, property, and casualty, but they do specialize. If you read down there a little bit further, they specialize in excess and surplus lines insurance. You know, what the heck does that mean? I did spend a little bit of time researching that. And I learned that that's a type of insurance coverage for businesses or consumers who are really unable to obtain coverage in standard insurance markets. These might be to insure unusual or higher risk situations, but things that the typical, the traditional property and casualty companies don't take on. They're pretty much exclusively in this area. And you can see that that's been going very, very well for them. I will say that as far as competition, this is a small company. Look at it, it's only got $819 million worth of sales. The big primary player in this industry is Lloyd's of London. We've all heard of that. Berkshire Hathaway comes in second. So this is a small player in a fairly large market, but look at those lines. They did go public in 2016, so it's fairly new. You can tell that because there's price bars. That's when those started. Even though we have data back here, the price bars didn't start until 2016. So that's when they began being publicly traded. All right, so what's not to like about this? I noticed when you were sorting your list, I didn't realize this before, but on whatever list, the small company list, it had the best sales growth, 37.8%. That's outstanding. And look at how steady and straight that is. It's remarkable. You kind of wonder, can they keep that up? But that's great. 33% on earnings. That's great. Oh, I was looking to see, it's a small company. It doesn't have a lot of coverage. They do have a little bit of coverage. I did put this on earlier when I was looking at it, looking at the detailed estimates because there wasn't a long term. I just wanted to see what the analysts, I think it's only a single analyst maybe looking at that, think. All right, so great historical growth. Nothing wrong with these evaluate management numbers. The pre-tax profit is nice and steady. Return on equity is going up. Debt is at a very manageable level. And yes, it did go up in the most recent year. I did not research why, but still, that is a very manageable number. Flipping it over real quick, or going to the next tab, I should say. I know, we don't flip over anymore, but anyway, we still do. I will point out that this is right around where the average PE is at 34.6. This is 35.1. If Ken's numbers were the same, those numbers are identical because those are so close. It's expensive for me. It's an expensive stock. 35 is starting to make me a little nervous for a PE, but they've got exceptional growth, exceptional consistency, and we all know that PEs tend to go up for companies like that. So if this is something that you might be interested in, it's definitely one I'm going to keep an eye on. So put it on your watch list. All right. Next up is you, Ken, with what would you like?
Let's do TechnoGlas, TGLS.
TechnoGlas. not TechnoGlas.
TechnoGlas, thank you. Okay. And I'm looking at a very small company, $717 million in the most recent fiscal year in sales. They haven't reported their fourth quarter for this year yet. They will be doing that the first week in February. I'm looking at what is a fairly common kind of 10-year history for a small company, especially one under, let's say, maybe 800 or 700 million. That kind of zigging, zagging on the earnings line for the old data is fairly common when you're looking at a very small company. It many times takes a little bit of time for that small company's management to get a hold of the reins and to guide things in the proper direction so that you get consistency not only in sales, but then you can translate that consistency to earnings. We happen to know for more advanced investors that the distance between the green line and the blue line is roughly expenses. And when you're looking, and that includes taxes, and when we're looking at expenses, when those two lines are getting closer together, I know that the company is beginning to manage expenses fairly well, and I should look for an increase in profit margins when that's going on. Well, I go down to the bottom and I look at pre-tax profit margins, and sure enough, there's that increase in profit margins. It was quite dramatic from 20 to 21 and again from 21 to 22. They won't be able to squeeze much more out of this, but the very fact that they were able to move it up to those places, we're going to hope now that they can keep it elevated in some way and keep the company moving forward. This was a Colombian company that has opened their home office now in Miami, and it's now an American listed company. The Colombian company did all of its manufacturing in Colombia, and that's where the manufacturing is still done. These folks make glass, all kinds of glass, really, really regular glass and really, really fancy glass, glass that filters sunlight, glass that's resistant to hurricanes, glass that can darken when the sun gets too bright and can also move in different directions in different parts of the window to make it appear to be moving as far as giving you an optical illusion. All kinds of different things. They have about half of their business in residential construction and about half of their business in commercial construction. If you were to stand in downtown Miami, which is full of pure glass skyscrapers, and look at the buildings, about 85 to 90% of the glass that you could see in downtown Miami was furnished by TechnoGlas. It's just a company right now that I think that we might have discovered on the verge of becoming extremely profitable. And that's what every single better investor is always looking for. The next big thing that will allow you to keep the company for 5 or 8 or 10 or 15 years and make a steady, healthy profit during all of those years. I like the management comparisons down at the bottom. They're bringing their debt down to manageable levels. And in fact, in 2022, they moved under that 33%. Their return on equity, anything over 20 is superb. At 49.9, I don't have the adjective to describe it, but it certainly is really great. And the profit margins that we've already talked about moving in the right directions. Let's look at the valuation really quick. We have a company with a 17 average 5-year historical PE and a current PE of 10.5. What that tells me is that if the company maintains that 17 average, then this company right now is undervalued, and it might be something that could be considered on sale or a bargain. It might be. So I urge you to do your own homework. I urge you to take the time. I will tell you that we've been talking about this stock since it was in the low 30s, and now it's in the mid 40s, and it went up another 2% today. So take a look at this stock, TechnoGlas, TGLS.
All right.